Hello and welcome to the third lecture video on chapter 14 where we're talking about long-term debt. We've comprehensively covered bonds payable in great detail. We've seen the straight line method of dealing with the amortization of a bond discount and a bond premium. We've seen the effective interest method, and we've also seen what happens when bonds are retired early or when they are extinguished early. Now let's look at a different type of long-term debt, and that is specifically notes payable. Keep in mind the primary difference between a bond payable and a notes payable is that a bond payable has multiple lenders, but a notes payable has one single lender, one bank or one other financing institution. So I don't have to spend a ton of time on dealing with long-term notes payable because you've seen the flip side of this in intermediate one when we talked about long-term notes receivable and we were dealing with zero interest-bearing notes. Where we're going to see this in the same vein, only we're only looking at it from the borrower's side, not the lender's side. So how we account for bonds and notes, very, very similar. The same way I can issue bonds at a discount or a premium, I can issue notes payable at a discount or a premium. We still need to amortize the discount. We still need to amortize the premium. And we still value the note at the present value of all of the future cash flows, which include the maturity or the principal amount of the long-term notes payable, as well as the interest payments. So we have this corporation issuing a $10,000 three-year note at face value. And at face value means there's no premium, there's no discount. The market rate of interest is the same as the stated rate of interest, or the effective rate of interest is the same as the contract rate of interest. So to record the issuance of the note, when you borrow money, you get money. So we should be debiting cash and crediting notes payable. We're going to recognize the interest that happens every single year because with this particular loan, we're probably going to pay back the full $10,000 at the end of the 3-year period, but we're required to pay interest annually. So we debit interest expense and we credit cash every year until the note matures. Now, with a zero interest bearing note, interest is implicit in the note. There are no cash interest payments, but the amount of money we receive is different from the amount of money that we're going to have to pay back. So the company that's issuing the note has to record the difference between that principal amount and the present value, which is usually the cash received, as a discount. And we have to amortize that discount to interest expense over the life of the note. So instead of debiting interest expense and crediting cash, we're debiting interest expense and we're crediting discount on notes payable to amortize it or slowly get rid of it. So this time we have Turtle Cove Company issuing the 3-year $10,000 zero interest-bearing note to Jeremiah Company. The implicit rate that equated the total cash to be paid, which is $10,000 at maturity, it equated it to the present value of the future cash flows, which ended up being $7,000 and some change, and that implicit rate was 9%. What does this mean? We're borrowing $10,000, I should say, we're borrowing a sum of money. But the sum of money that we're getting is different from what we're having to pay back at the end of the life of this note. The amount of cash we're going to get is $7,000 and some change. The amount we're going to have to pay back at the end of this 3-year period is $10,000. There are no cash interest payments. But the difference between this $7,000 and some change and this $10,000 is the cost of borrowing money. And we call the cost of borrowing money interest. That's what we mean by a zero interest bearing note. So when we do this initial entry, we debit cash for the amount of cash that we're going to get, $7,000 and some change. We credit notes payable for the principal amount of this note, and the difference is the discount on notes payable that we will have to amortize over the life of this note. Now we're going to amortize it using the effective interest method, and you have experience with the effective interest method at this point. You take the carrying amount or the carrying value of the note and you multiply it times that implicit rate. Let me go back so that you can see, because this is a zero interest bearing note, so I can't use the rate that's on the note. It's zero. I have to use the implicit rate, or the market rate of interest. And then that gives me the amount of interest expense. There's no cash paid, so my interest expense is the amount of discount that is being amortized. I'm going to add this amount to the carrying amount of the note after I do my whole amortization process to find my new carrying amount. Just like bonds, the carrying value of the note has to be equal to the principal value, or the face value, or the maturity value of the note at the end of the note's life. So in the entry to record interest, instead of crediting cash, I'm just crediting discount on notes payable. I'm hoping that this is a review for you, because I can promise you we did it in Intermediate 1. Now, let's look at an interest-bearing note. So this time, the corporation issued for cash a $10,000 3-year note bearing interest at 10%, but the market rate of interest is 12%, even though that contract or stated rate is 10%. The present value of the note is calculated to be $9,520. So we know that this note is issued at a discount. Notice the market rate is higher than the stated or contract rate. The amount of cash is less than what we're going to have to pay back. So when we record this note, we're going to debit cash for the amount of cash that we're receiving. We're going to credit notes payable for the principal amount, and we debit discount on notes payable in order to make our entry balance here. Now, we still calculate interest the same way using the effective interest method. The big difference is now we have a cash interest payment. We find that cash interest payment by using the principal amount times that stated or contract rate of interest. And that's where that 1,000 comes from. We find the interest expense by taking the carrying value of the note and then multiplying that times the market rate of interest. The difference between the two gives me the amount of discount that will be amortized once I do my entry for the interest expense. And we have to add that to our carrying amount, because notice the carrying amount will increase until it reaches that principal amount. So when we do our first entry, I'm going to have interest expense, I'm going to have cash paid, and I'm going to have to do something with that discount on notes payable. Discount on notes payable is similar to discount on bonds payable in that it is a contra liability account, so it does have a normal debit balance. So as I'm trying to get rid of it, I do need to credit it to decrease it. Now, there are always some special situations, and when a note is exchanged for property, goods, or services, we're saying that the interest rate that is on that note is fair. Or in other words, it represents the fair value of those goods, property, or services, unless there's no interest rate that's stated, or if the interest rate that's stated is way low, like 1% or 2%, or if the face amount of that note is materially different. There's a huge difference between that and the current sales price or cash price for the goods, property, or services that we're talking about. In other words, if a note is issued and the fair value of the goods is the same as the value of the note, there's no discount or premium. But if that fair value is different because there's no interest rate that's stated, or because the interest rate is unreasonable, or you can just look at the value of these goods and somebody else has to buy and they have to pay $10,000 for them, but the note is being issued for $2,000, then that's an indication that the interest rate is not fair and there's going to be some type of discount or premium that we need to take into consideration. So what interest rate do we use? How do we decide what interest rate to use, especially for a note where there is no readily available market that I can compare it to? Well, I can look at notes that are similar. So I can use the prevailing rates for instruments or notes that are similar to what I'm dealing with, or I may have to factor in other things to consider, like collateral, how long the debt is outstanding. You know, usually the longer the debt is outstanding, the more risky it is, so the interest rate tends to be higher. Or we can look at the prime rate and mark up from the existing prime rate, or any other restrictive agreements or arrangements or covenants within the loan agreement. Now, here is an exaggerated example, and I say an exaggerated example because it's super long, where the interest rate that is on the note is not fair. And the fair value of the goods is not necessarily readily determinable. We can't assign a number to it. So what we have to use is the prevailing rate of interest to help us find the present value of this note, so that we can assign a present value to the value of these goods. So we have this company and they need to pay Brown Interiors for some architectural services. But if you, I'm skipping around, if you read ahead, the company can't readily determine the value of those architectural services, and the note, they can't readily determine the value of that either because it's not marketable. So the face value of the note is $550,000. But look at this interest rate, it's 2%. That doesn't seem to be reasonable. Usually interest is much higher than just 2%. So just looking at that information, we'll continue reading. On the basis of the company's credit rating and the absence of collateral, the prime interest rate at that date, and the prevailing interest rate on all their other outstanding debt, at an interest rate of 8% is a whole lot more reasonable. So what does all of this mean? We're going to use the 8% to help us find the present value of this $550,000. And then that's going to help us determine the value of those architectural services. So we are going to discount this back to help us find the present value of this note. The discount rate is going to be the 8%. And we need to find the present value of all future cash flows. That includes the principal and the interest, because remember, there was an interest rate. It was 2%, super low, but an interest rate nonetheless. So when we find the present value of this note, we see that that number is lower than the face value. When we do this entry, we're going to assign the value of the architectural services. We're going to assign that as the 418, or the present value of the note, using that prevailing rate of interest of 8%. So we can still create our schedule using our effective interest method. I've shown you this at least 5 times by now, so you should be pretty clear on how to calculate interest expense, and you're backing into the amount of amortization on the discount, and that carrying value continues to increase until it reaches the maturity value of the note. So we record the interest expense, we amortize the discount, and we record the cash payment of $11,000. Now, another type of notes payable is a mortgage notes payable. And all that simply means is that the loan is collateralized by the title to the property. So you find this a lot with homes. Yeah, if someone can't pay the notes payable on the home, then they lose the home to the bank. And that's because that home is, or the title to that home is the backing behind the promissory note. So this is the most common form of long-term notes payable. I don't want you to think that it's any different from a notes payable. It is. It's just there's collateral backing that notes payable. It could be fixed rate. It could be variable rate. You could have a balloon payment where you have to pay the full amount at maturity, or it could be paid in installments. So let's look at some presentation and disclosure issues. Companies have the option of reporting their liabilities at fair value. Now, once they make that fair value election, when they first get this debt, they pretty much have to stick with it. They can't flip-flop back and forth and say, oh, now we're going to use amortized cost, now we're going to use fair value. Once you select it, you have to stick with it. FASB, or the Financial Accounting Standards Board, they believe that fair value is actually a better measurement than amortized cost. And when I say amortized cost, I'm talking about the value of the note plus or minus the premium or the discount. Remember when we were showing it at its carrying value? That's a fancy way of saying that is amortized cost. So when it comes to debt, it probably is best to show it at its fair value. But it's interesting because we use amortized costs for our internal records. And then we find the fair value and we make a fair value adjustment at the end of the period. So any changes due to fair value represent, at the end of the period, they represent an unrealized holding gain or loss. And more often than not, they are shown as a part of net income. So we put dash income, if you remember that from intermediate 1 as well. In some situations, it may be reported as other comprehensive income. So we put dash equity. So let's see an example. We have Edmunds Company has issued $500,000 of 6% bonds at face value on May 1st. And Edmund chooses the fair value option for these bonds. It's now December 31st, and the bonds are worth $480,000 because interest rates in the market have increased to 8%. We're still going to take care of this on our books or in our internal records at $500,000. But when it's time to show this on our balance sheet, because we've elected the fair value option, we need to show it at $480,000. So this represents an unrealized holding gain or loss dash income. So for this specific example, just because the interest rates have changed, the value of the bonds has changed. So we debit bonds payable to reduce it, and then we credit unrealized holding gain or loss dash income. Now, if the value of the bonds or the value of the debt changes because the company's credit rating changes, or because they're more of a risk, meaning I can isolate this to the company itself, not the market, then I have to show that change in other comprehensive income. If the change is solely related to the market, then it shows up on that unrealized holding gain or loss shows up on the income statement as dash income. But if it's because of a credit risk, then it has to be shown as other comprehensive income. And I know you're looking at this, like, unrealized holding gain or loss. Why am I crediting it? Well, it does represent a gain. This is debt, something that we're going to have to pay. And we're saying that it should have been worth $500, but because interest rates in the market have increased, we would only have to pay back $480,000. That's all it's worth. So that does represent a gain, but it's an unrealized gain because we haven't sold the debt, we haven't paid off the debt. But just keep in mind, if it's a credit risk, put dash equity, it's other comprehensive income. But if it's because of the market, that change happens because of the market, it is dash income. It shows up on the income statement. Now, another special issue that we have to definitely pay close attention to as it relates to debt is off-balance sheet financing. And this is when companies attempt to borrow money in multiple ways so that they don't have to show the debt on their financial statements. And I know you're like, is that even legal? Well, yes, it is. Because there are different ways that you can do this. You can do this by having a non-consolidated subsidiary, or you could have special purpose entities set up for the purpose of off-balance sheet financing. So what do you mean? Let's say that I'm a company and I want to build a building, but I already have a ton of debt and I need to borrow, I don't know, $500 million in order to build this building. But I already have a ton of debt. So what I will do is set up a special purpose entity, another affiliated company. And this company's job is to build me a building. And when they finish building the building, I will pay them for that building. So I will enter into an agreement with this company that I set up for the purpose of building a building. And in that agreement, I'll say, once you finish building me the building, I'll buy it. You can transfer it to me. But what that company now has is an agreement that will be a revenue source for them, because I'm going to give them $500 million. So then that special purpose entity will then go to the bank and say, look, I have this agreement with this company, and they're saying that they're going to buy this building from me. And that special purpose entity will be able to borrow the money from the bank, because the bank will look at that special purpose entity and say, okay, based on what you have, you've entered into these arrangements before and you were successful and you are making money. So because of that, we'll loan the money to you. So then the special purpose entity takes the money, builds the building, transfers it to me, and then I funnel money to, or not, I shouldn't say funnel because it makes it sound bad, but I give money to the special purpose entity so that they can then pay back the debt. Now, who's really borrowing the money? The special purpose entity or me? Me. The special purpose entity only exists because I created it. I don't have to show that debt on my financial statement. Why? The special purpose entity shows the debt. I might have to show that I have an agreement with this special purpose entity to purchase this building when it's finished, but I don't have to show it on my balance sheet. Totally legal. The only problem with this is that this is what Enron engaged in. The primary problem with this is that when Enron did it, they did not disclose it. So no one knew that Enron was saddled with all of this debt because of these special purpose entities that they had set up. And not only that, there were also key executives that were taking money off the top, and they made tons of money on all of these special arrangements that I'm mentioning as an example to you. So off balance sheet financing is a good way to borrow money without having to show the debt on your financial statements. But you just need to disclose it in the notes to the financial statements. You have to disclose that you have all of these arrangements. And here's the rationale. Here's why I say it's a good way to do it. Assets are usually undervalued. And I'm starting at the bottom here. I always start here because GAAP doesn't mind if we're conservative as far as it goes with assets. They can be grossly understated as long as they're not overstated. We don't care about that. Well, because our assets are understated, we can probably handle more debt than what our balance sheet shows. So it's okay if we engage in these transactions with this off balance sheet financing as long as we disclose it. The stockholder needs, or the potential investor needs to know that we have these arrangements. Sometimes loan agreements can limit the amount of debt that we can get, whether we're able to pay it or not. I may be able to pay it, but I may be in another loan arrangement that says you can't have more than this amount of debt. So I set up a special purpose entity to help me handle that. And the last piece of this is that removing the debt does increase the quality of the balance sheet. And it does allow me to obtain more debt easily at a better rate. Because I already have debt on my balance sheet, my special purpose entity that doesn't have a ton of debt or may not have any debt at all can get a better interest rate than I can. So I can obtain financing at a lower cost. So there are definitely some pluses to this, but the largest minus, or the largest detractor, is when you don't let the investors know that you have all of these arrangements in place. So off balance sheet financing, not a bad thing. Just disclose it. That's it. Now, other things that should be disclosed as far as it relates to long-term debt: maturity dates, the type of liabilities that we're dealing with, any interest rates, if there are call provisions or call premiums, we can convert the debt into stock, any restrictions, any collateral, all those things have to be disclosed. In addition, even if we're not using the fair value method, we still need to disclose the fair value of the debt, because if that fair value is a whole lot more than what is on the balance sheet, an investor needs to know that, or a whole lot less. Either way, the investor needs to know that. And any payments that we may make to sinking funds or for our long-term debt within the next 5 years, we have to disclose those future payments. That gives the investor a better idea of how cash will be encumbered over the coming years. So we can analyze long-term debt by using some of our ratios: our debt to assets ratio, our debt to equity ratio. You've covered these ratios in Intermediate 2, as well as times interest earned. How much of our net income can we actually devote to, how many times can we pay our interest payments using net income? And in terms of accounting for debt restructuring, that is way beyond the scope of what I need you to know. You get to your master's level, you can take this is probably a whole course in and of itself, but you can take a higher level course and learn about how to deal with debt restructuring and structuring. But that's way beyond the scope of what you need to know. But that does take care of the entire chapter 14 lecture. You can go back and look at some of the differences between the international standards as well as GAAP. But again, that's something that will definitely be covered at your higher level when you move on to get your 4-year degree as well as your master's. But I so appreciate your time and attention, and I hope you have a wonderful day.